Hey, business owners, welcome tonight at our presentation. We're going to be talking about how to prepare your marketing firm and how to understand the value of your marketing agency. Okay, so we're going to talk about these two premises, but we're going to spend most of our time actually addressing the question about how you value properly your marketing agency. Okay, so I'm going to go ahead and share my screen here with us so that we all can be on the same page. Okay, um, so let's do that. Okay, perfect. We are good to go. Okay, so again, I want to welcome everybody to today's live. My name is Lunta Di La Paulo. I'm a CPA. I help small businesses across the nation, okay, improve their business profit, minimize their tax liabilities, and maximize their cash flow, okay? If you are a business owner who need help with one of these three or all of them, I'm really available to help you, okay? So with no further ado, let's jump into our topic today. So, I hope you are able to see my screen here in front of us. And we're going to talk about how do you value your marketing agency? How do you determine the value of your agency? If I go to Whole Foods and pick any product, I know the price for that product because there is a ticker that tells me exactly the price of that product. Okay. But if you are a business owner, you need to understand the value of your business, right? And we're gonna talk about why that's also important and what are the frameworks we use to arrive to the value of a given business. Okay. So just to give us a roadmap today, we're gonna talk about the what. Okay, what is valuation to begin with? Okay. Hey, the blessing of Chicago. A lot of ambulance here. Okay. So number one, we're gonna talk about the what. Okay, what's valuation? Okay, what's the key concept around it? And then we're gonna move around the why. Why do we often have to rely and use valuation? Okay, and then lastly, I'm gonna share with you the meat of what today's presentation is actually largely about. Okay, so we're gonna talk about the framework that shows us how we actually arrive to valuation. So a lot of what we're gonna do tonight is largely conceptual, okay, to give you framework, to give you the right information so that when you get to a place that requires a business valuation, then you'll know, okay, what to look at, what to pay attention to, what to ignore, what is relevant and what is not relevant. Okay. So let's start. Number one, what's valuation? Okay. What is valuation? I hope you have some ideas. You've heard about valuation. Some people would say valuation is art and science, right, of finding value. But the key question that valuation seeks to answer is what's an asset's worth? Okay, in this case, what's your agency's worth? Okay, valuation is essentially a process or methodology that allows us to get to the true value of an asset. Okay. And sometimes it can also be a liability. Okay. Sometimes we have to do evaluation on a liability to come to the value of that liability. Okay. So that's in general what valuation is. So I'm going to repeat it one more time so that we all are on the same page. Valuation is a process or methodology that allows us to arrive to an understanding of the value of the worth of an asset or liability. Okay. That's what valuation is. So again, the key question that valuation seeks to answer is what's the worth of a given asset or liability. So I hope you're following me, okay? So when we look into the value of companies like Facebook, Apple, Google, well, not necessarily Facebook today. It's Meta, Alphabet, right? The parent companies. Okay. Oh, look, what is trending on the news today is um, Nvidia, right? That the company's value now rose above Apple, right? Apple's valuation. So when we talk about right the value of the firm, it of publicly traded company, it's simple. We can simply go online, do a Google search, the company and stock price, or even the market share. We can arrive easily to what a given publicly traded company's worth is. But that's not the same thing. It's not easy for a company that is not publicly traded, right? So for most companies in America that are small businesses or privately held, it's hard to develop an understanding of what's the worth of that company, right? Whether you are trying to sell the business, as we will see why valuation is important and in what context, right? Valuation is useful, right? Understanding what's the fair market value of a given asset is remarkably important for all of us, right? Oftentimes, I have business owner who come to us needing help, and we have to begin with this conversation before even, right, starting to run the number, asking question, doing our due diligence, because we want to make sure that the business owner understands what the purpose of valuation, what we are doing, and why it's useful. Okay, so that's the reason we're here in this live today to show you, okay, to communicate the key information you need to have to understand what's valuation, what, why we use valuation, and how the final number or numbers come to be. Okay. So for publicly traded company, you and I know it's easy to find the value, the market value of these companies. But for privately held companies, it's not that simple, right? So therefore, there is a need of professional appraisers or professionals who do valuations of companies. Okay. So an easier way to give us a context around how valuation is used, for example, we can look into what most of us are familiar with, right? When you need to buy a house, the bank requires you to have an appraisal done on the property, right? Before they can underwrite the mortgage, right? So it's very important that you understand the methodology around evaluating the assets. But for our purposes tonight, right, we're talking about valuation in the context of small businesses, privately held businesses, and specifically marketing agencies, right? Although the methodologies can be used across the board, but my goal here is to help marketing agencies, you, okay? So after we do that, right, before we start looking into how valuation actually come to be, right, let's talk about what valuation is useful for, okay? When you merge or you want to acquire or sell a company, right? There is a need to determine valuation. So in a merger, for example, when two marketing agencies want to merge, right? So what needs to happen is we need to determine the value of company A and the value of company B, and so that we can determine the fair exchange that the value of this marriage, right? So that the shareholders of this entity maintain their respective value, okay, in the firm, right? When you need to acquire another marketing agency or any other small business for that matter, you need to have a clear understanding of the value of that business unless you want to pay more than you should have paid for that specific asset or business, right? Even when you need to sell your company or when you want to break up a piece of your company, right? To sell it to third parties and maintain one specific piece of the business, right? You need to understand what's the overall business value and what's the standalone value of specific parts of your business or specific units of your business, okay? When, especially for limited liability companies or limited partnerships, buy and sell agreements require to have evaluation approach, right? Or when you need to raise money, especially for startups or business in growth mode and they need a little bit of capital injection to really take off, right? We need to have valuation so that we can determine, okay, the value of the investors coming in into the firm, right? And then employee stock ownership plans, right? So that's also another piece in another type of transaction or situation that requires valuation. Employee benefit plans, when you submit a bank loan application, right? Especially when you are seeking to buy a very large asset or another business, right? The bank will require you to have evaluation. Unfortunately, life happens, right? For families that have a lot of assets in their balance sheet, and when a marriage dissolves, right, there is a need for valuation as well, or for people who donate large assets to non-for-profit organization, some of them need valuation, okay? Or even in courts, right? So valuations are also necessary for state planning and taxation purposes. There are situations that clients will come and require valuations. Okay, so but the main reason a lot of the clients that come to our firm seek valuation are going to be for M&A transactions or for business owners who need to get a sense of what their company's worth is so that they can determine, okay, when they're writing their will or they're doing their estate planning, what assets should be given to whom. Okay, so this is not by any means a comprehensive list. Okay, this is a short list of situations and transactions that require valuation. But I imagine for you as a business owner who is either looking to buy a business, valuation is critical for you, or a business owner who's looking to sell their company, valuation is also critical to you. Okay, because the incentive of the buyer is to buy at a lower price so that they can sell high and get a higher return on their capital. But the motivations of seller is to sell at the highest possible price, right? So that they can, especially for business owners who are near or moving into retirement, selling a business could be that last large check they will get in their life in their life for the rest of their life. So it's very critical to know, okay, I'm here. I need to understand how valuation actually comes to be. So let's talk about how valuation is done. So there are three methodologies, three approaches to valuation. Okay. And none of them, I would say, is better than the other. For marketing agencies, right? I've been in transactions where we had to rely more or put more weight in one methodology versus the other. But at the end of the day, there is a science for sure, but there is also an element of art, a little bit, a lot of professional judgment, right? A lot of assumptions that goes into valuation. So working with the right professionals is critical. Okay. But here's the three approach that I want to give you. First one is the income approach. The income approach is essentially the type of methodology that relies on two primary factors, right? Number one is the income ability, the income capacity of your firm in the market, right? So if your business is generating, let's say, $1 million in EBITDA, right? Earnings before interest, taxes, depreciation, and amortization, or in much smaller businesses, it's considered the seller discretionary earnings, right? We get that number and then we multiply by an industry average, right? So a lot of marketing companies, by the way, sell at four, four, 4 to 10 multiple. Okay, so depending on your size, depending on you know on the firm itself, your multiple could be lower, could be higher, right? It just depends. But the key idea here is around the income. Is your company producing enough income to make it attractive for other buyers, right? So if your business is generating low profit, right, you really need to work on boosting that profit and therefore driving value higher, right? So if your business is really great and at bringing revenue, but the bottom line is very slim, right? You might want to work a little bit on understanding where you're losing most of that top line so that you can actually bring your bottom line up, right? So we work with business owners where we do a free cash flow, free profit and cash flow analysis for them, and we help them see where the problems are in their business and what they can do to actually change the course of their business. So there is a link in the comment. Please check it out so that you can also see how we can help you. Okay. So this is the number one income approach. Okay. So based on your income, that's how your valuation is determined largely. Okay. So you want to make sure that you understand concepts like EBITDA, right? Earnings before interest, taxes, depreciation, amortization, or seller discretionary earnings, or EBIT, right? Earnings before interest and taxes, or free cash flow. Seldom I see people valuing the business based on the free cash flow because it's often the smallest number. Okay. Most people use either EBITDA or SDE. Okay. So you want to make sure you actually understand what's been added or removed into each one of the measurements of income that is being used to calculate your valuation. Okay, so make sure that you know you understand that, you get that. Okay, and then the second approach is the comps approach, right? Or you'll hear other people say comparable approach, right? So let's just go back to the real estate example for a second, right? Often in real estate, when you buy a real estate, when you are about to buy a real estate property, one of the key things that is done for you is to show you your appraisal reports, right? And in your appraisal reports, the key methodology that is used for real estate deals is the comps, right? They'll show you the price that other houses or apartments or units similar to what you're looking to buy sold at the marketplace. Okay, so that's really what is taking place, right? So when we approach businesses, that's essentially what's also taking place, right? So we're looking in the marketplace, and we need to make distinction here about the marketplace. We need to make sure you understand these two distinctions, right? So on one end, we have the privately owned businesses, and then we have the publicly uh, traded businesses, right? So we go in the marketplace, we find companies in the private sector that sold, right, that changed ownership, right? and see, for example, let me just put it into our reality. So one of the things we would do, right, when we're doing a comms analysis for a marketing agency, we'll look into the data, maybe the last 2, 3 years of companies that sold in the private sector, right? So when I say private sector, in non-publicly traded space, okay? So we're gonna look into these companies, we're gonna look into the comps, but it's always important to pay attention because we know the last 3 years we had the pandemic, okay? The value of companies were significantly impacted during the pandemic years. Maybe we could go a little bit farther, right? So that we can actually come up with numbers that could reflect the reality, right? And come with a normalized mean or average around the valuation numbers, right? The comps numbers, excuse me. That's in the private space. In the publicly traded companies, we do the same thing as well, right? We go in the publicly traded market and we look into publicly traded marketing companies, right? That are similar enough to the company that we are evaluating. But here's the problem that I often see all many appraisers and evaluator or business valuation professionals making, right? They'll go in the publicly traded space, and they will just get a list of all the publicly traded companies and then use them as the metrics, right? But that's not necessarily the best way of doing this analysis, right? Because you have situations where we're looking into a much smaller, privately held marketing agency that we're trying to figure out the valuation for it, right? And if we're gonna go get a marketing company that it's worth 2, 3 billion dollar and compare it to another marketing company that is generating less than 3 million in revenue, that's not necessarily apples to apples, right? The other issue that I often see is professionals not looking into what actually these companies that they're trying to compare do, right? Some marketing companies, for example, are gonna be doing literally everything, right? Everything from SEO to publishing to social media management. But while other marketing agencies are going to be doing maybe just lead generation or marketing consultancy or market research, right? So it's very important, it's imperative when we're running our comms analysis, we do understand that we are trying to get as close as possible to companies that are similar enough, right, to give us meaningful information, because we all know that no two companies are equal or largely similar. Companies are going to be different. They are different leadership style. They are different approach to have a strategy to compete in the marketplace. They have different talent pools, different skill set, maybe different offerings as well. So this methodology really requires an in-depth analysis, right? It's not just a matter of going into a database, pulling down the information and putting there, crunching the number. That's it. That's not gonna cut it. That's not gonna cut it. That's the worst possible way of running your comms approach. Okay. And professionals who are doing that, okay, I would even say that they are very close to malpractice. Because if you are a professional, you know you need to have a skeptical mindset, right? When you're looking into different companies, some companies are showing you a trading multiples of, let's say, a PE of 5, 6, 7, 4, five, six, seven, and then suddenly you see two companies with multiples of one, other multiples of 20 and 30. These are clearly outliers. Therefore, you shouldn't include them into your analysis. So these could be removed unless there is a good justification that we can come up with to support the fact that we left them into our analysis for X, Y, Z reasons. Okay. So very important for us to actually keep track of this kind of information. Really important. And then the last approach that we often look at is the DCF approach, right? Other people consider this the fundamental analysis, right? It's the methodology, the approach, or the framework that is driven by a very extensive analysis of the business fundamentals. When I say business fundamentals, what I'm saying is we're looking into the historical performance, the operations of the company, to come to the absolute value of a given asset. In this case, of your marketing agency, right? We look into the P&L, we look into the balance sheet, we look into your cash flow, right? And then we come up with a WACC, which is weighted average cost of capital, right? And then we discount the future cash flow based on that WACC, right? Excuse me, so that we can arrive to a number that would approximately reflect the current, the today's value of your company. So again, you probably already realize that this methodology has significant number of assumptions, right? Because we need to build a pro forma financial projections, right? And we have to build a model that takes into account our revenue projections, right? If our revenue is off, it's going to be a big problem, or significantly off. It's going to be a larger problem, right? And we also take into account, right, the operating expenses, the cost structure, right? Ideally, we want to see the projections to follow similar patterns to historical data, right? If there is a major deviation, we need to justify why we believe the company it's going to perform significantly different to what it has done historically, right? And all of these needs to be documented, right? All of this needs to be documented. I've come across to evaluation reports that doesn't provide assumptions for their projections. And I just can't understand how you build evaluation report where you do not include your assumptions. Okay, so business owners, you gotta pay attention. You gotta know the professionals you're using, what they're doing, how they're doing, and why they're putting certain things on the paper and producing the reports that they're giving to you. Okay, so gotta make sure that you're following and you're paying attention to what's happening, because the evaluation report, when someone wants to buy your company, for example, your professional let's say your professional comes up with evaluation report that is ill prepared, that didn't follow proper methodology, and overvalue your company significantly, and every single buyer comes and makes an offer. And I have seen this happening, right? I've seen people coming and saying, hey, look, my business is $20 million because my friend told me, because my buddy in the country club told me, because the valuation professional who did evaluation 1 year ago, 2 years ago told me, and here's the report, right? And then the market is coming telling them, hey, we're gonna pay 7 million, 8 million, and that's top, right? And they just can't understand why people aren't willing to pay more, because they have a set of assumptions about the business and the overall market that you did not take into account, right? So as a business owner, you really need to have a skeptical mindset as well, right? To ask questions, to question the assumptions, why your professional is telling you this and not that, right? Why they are telling you, a certain fact, like what's supporting that fact. Okay. So it's very important for us business owners to have a very a very much skeptical mindset, because the DCF approach really requires a lot of assumptions, a lot of assumptions. And if you are just gonna simply sit back and let all these assumptions fly without challenging them, right? Somebody's gonna come and destroy your valuation report in a single minute, and you're not gonna be able to defend what you had in paper, right? So as a business owner, your business value is an important item that you need to know. If you don't get it, if you don't understand how your business is being valued, what's important throughout your valuation, you're going to be losing value. Okay. You're going to be losing money when you decide to sell your company or when you pursue another deal to acquire it. Right. So which methodology is the best? As I said at the beginning, there is no single right or wrong approach. Sometimes we combine the methodologies above. Sometimes we rely on one methodology over the others. Okay. Sometimes we, use our best judgment. We've had situations where we actually had to use the liquidation value. Okay, when we had a company that is very close to default on its obligation and be forced into liquidation. So the valuation sometime it's gonna vary based on the asset, the condition of the company, right? So that we're actually bringing right information that is reliable, that is trustworthy, that we can defend, right, and not just numbers that we pull out of thin air. So I know we've been about 30 minutes now, and this is probably a good place for us to pause. I want to share my contact information with you. If you want to reach out, please, here's my contact information. You can find me on our website. We have a free ebook that is 7 Mistake Digital Marketing Agency Make that could put them out of business. Please download. If you want a free copy, it's going to be at www.luntadilapaulo.cpa.com/7mistakes. And if you want to reach out to me, I'm on WhatsApp on my normal phone number. The number is also there, and my email address. So thank you for your time today, and I hope to see you on the next live next week on Thursday at 5:30 p.m. Central Time. Okay? Have a great rest of your day. Have a great weekend, and God bless you.